Welcome to the deep dive. Today, we're going to cut through some of the noise around the latest financial results.
Yep.
We're diving straight into Costco Wholesale Corporation, specifically their Q4 and the full fiscal year 2025 numbers.
Right.
And our mission really is to look past just the massive total sales figures.
Yeah.
We want to get to the strategic heart of how this retail giant is actually performing.
Yeah, exactly. And that heart, I think, it really comes down to maybe three things. Loyalty, how efficient they are operationally, and this digital acceleration that, honestly, a lot of people aren't really giving Costco enough credit for.
Right. It's easy to miss that part.
It is. So while the headlines are all about the sheer size, we're looking at how this, fundamentally physical retail company is managing some pretty explosive growth across the board, really. Digital, international, membership.
Okay, so let's start with that big picture then. Lay out the headline numbers for us.
Sure. So Q4 net sales, they landed at $84.4 billion. That's up 8.0%.
Okay, pretty solid.
And for the full fiscal year, $269.9 billion in net sales. Growth there was 8.1%.
Huge numbers.
Yeah.
Absolutely massive.
They are. But here's the thing, the nugget we need to start with. Those sales figures, they're really an effect, not the cause.
Okay, so what's the cause then?
It's that legendary membership engine they have. We really need to understand how they keep that customer loyalty so incredibly high. Because that is the war chest, right? It funds everything else they do.
That makes sense. It's the foundation of the whole model.
Yeah.
So, okay, how strong are those loyalty metrics? Let's forget the famous hot dogs and the cheap gas for a minute.
Yeah.
How many people are actually sticking around, renewing that commitment?
Well, the fidelity is, it's rock solid. Worldwide membership renewal rate, it sits just under 90%, 89.8%.
Almost 90%.
But get this, if you drill down into their really mature markets, like the U.S. and Canada, where they've really perfected the model, that rate jumps up to 92.3%.
92.3%. That's incredible retention.
Yeah.
Is that sustainable?
It seems to be. That level of retention, it basically means they've built this massive moat around their core business. It's very hard to compete with that kind of loyalty.
And what does that translate to in terms of actual people, like bodies in the warehouses?
The scale is just immense, and it's still growing pretty fast. Total paid memberships hit 81.0 million. That's up 6.3%.
81 million paying members.
Yep. And then if you include the family cards, the secondary card holders, we're talking 145.2 million total card holders, up 6.1%.
Okay, so that loyalty, it must translate directly into profit through the membership fees themselves.
Exactly. That's the key. Membership income saw really exceptional growth, up 14.0%.
14% on fees alone.
Right. And this is such a critical revenue stream because it's high margin, it's predictable, it's reliable income. This 14% growth, that's the money they can then use to subsidize those famous loss leaders,
Like the rotisserie chicken.
Exactly. Or price the gasoline super aggressively and just maintain that competitive edge on everything else in the warehouse.
And I remember seeing something about the high rollers driving a lot of that financial strength.
Yeah.
The executive tier members.
Oh, absolutely. They pay more for the membership and they spend significantly more. It's a crucial part of the strategy.
How many are there now?
We now have 38.7 million executive memberships. But here's the stat that really tells the story. 74.2%, almost 3/4 of total sales, is attributed to those executive members.
Wait, say that again. 74% of sales.
Yep. 74.2% penetration. So think about it. Less than half the actual membership base is responsible for nearly 3/4 of all the money flowing through the checkouts.
Wow, so they are absolutely the core focus. Their commitment is deep.
Totally. They're the engine within the engine.
Okay, so speaking of spending, how did that actually show up in the sales reports? Let's dig into the comparable sales numbers for Q4 and maybe focus on the adjusted figures, excluding gas and foreign exchange, like you said, to get the real organic picture.
Good idea. Yeah, looking at the total company for Q4, adjusted comparable sales growth came in at 6.4%.
6.4%. Okay. How did that break down?
Well, it's basically a combination of two levers, right? First, more people actually showed up. Comparable traffic, just pure foot traffic, was up 3.7%.
Okay. More people in the door. That's good. But wait.
Yeah.
Traffic up 3.7%. But the other lever, the basket size, what they call a comparable ticket, that only grew 2.6% adjusted.
That's right.
Given all the inflation we've seen globally, wouldn't you expect maybe a bigger jump in the average ticket size Does that maybe suggest members are pulling back a little on non-essentials?
That's a really perceptive read. It's certainly a bit lower than the kind of ticket growth we saw maybe during the peak pandemic spending times.
Right.
And while we don't have, item level detail here, that difference could suggest either some price deflation kicking in on key categories, or, like you said, maybe members are focusing more intensely on the essentials, tapping the brakes a bit on those bigger discretionary buys.
Interesting. And how about for the full year?
For the full year, the adjusted comp sales growth was actually very strong, 7.6%. So the momentum is definitely still there overall, but perhaps it's just, stabilizing a bit in Q4.
Got it. Okay. Let's look at the geography. Were there any particular hotspots? Which regions really drove this growth?
Yeah, definitely. The U.S. market, I mean, it's dominant in size, right? But it grew at 6.0% adjusted.
Okay.
But the international segments were really kind of on fire. Canada actually led the charge. They had 8.3% adjusted growth.
8.3 in Canada. Wow. What drove that?
Get this, phenomenal traffic growth, up 5.3% just in traffic.
So Canadians are really flocking to Costco.
Seems like it.
Yeah.
And the other international markets were also really strong, 7.2% adjusted growth there. So it tells us that their whole strategy of international diversification is really paying off, big time.
And it seems like they aren't slowing down the physical expansion either, still building new warehouses.
Nope, definitely not slowing down. They know that physical store is still the absolute centerpiece for converting and keeping those high-value executive members happy.
Right. The physical experience is key to that loyalty model.
Exactly. So the company now operates 914 warehouses globally. I mean, they're truly everywhere.
914.
Yeah. And we saw recent openings like Malmö in Sweden back in July 2025 and Allen, Texas in August.
So still investing heavily in bricks and mortar.
Oh, yeah. Their commitment to the physical model is crystal clear. They even put out a future goal, hitting 944 total warehouses by the end of fiscal year 26. They're absolutely doubling down on that physical anchor.
Okay, so the physical numbers look great, solid growth there. But let's switch gears to the part of the business that maybe seems to be moving even faster, the digital side.
Ah, yes.
This is where I think the real tension lies, right? This massive traditional warehouse club suddenly getting really good at e-commerce.
The digital numbers are, well, they're pretty explosive, honestly, and they really indicate a fundamental shift in how members are interacting with Costco.
Okay, give us the numbers.
Q4 e-commerce comparable sales, up 13.6%.
13.6% growth online in just one quarter.
Yep. But look at the full fiscal year. Adjusted e-commerce comp sales grew 16.1%.
16% online growth for the year. That's remarkable for a company that historically is defined by people pushing giant carts down wide aisles.
It really is. And if you connect this back to the bigger picture, that digital engagement is just soaring. E-commerce site traffic increased a stunning 27%.
27% increase in website visits. Whoa. So that suggests the new physical stores aren't, like, cannibalizing online sales.
Exactly. It looks like they're acting more like distribution hubs, maybe driving brand awareness and actually feeding that digital engagement. It's working together.
Interesting.
Yeah, 27% increase in traffic suggests that all those investments they've been making in the online user experience, they're paying off. Big time.
What kind of investments? Did they mention specifics?
They did. They specifically highlighted things like data augmentation to make the search experience better.
Okay. Finding stuff easier.
Right. And even small but actually crucial features like passwordless access for the mobile app on iOS and Android.
You know, that sounds minor, but it isn't really, is it? Every little bit of friction you remove.
Exactly. Every second saved means potentially less frustration, less cart abandonment.
And higher lifetime value for that member.
Precisely. They're using these pretty sophisticated digital tools now to just smooth out that whole purchase journey. They even mentioned implementing an online waiting room for high-demand items, the hot buys.
Like for the really popular stuff that sells out instantly.
Yeah. It shows they're actively managing those peak demand issues online, just like they'd manage lines in the physical store. It's becoming quite integrated.
That makes sense. And what were people buying online? Anything surprising?
Well, they moved a lot of high-value goods digitally, which really indicates trust in the platform now, even for major purchases. Gold and jewelry were apparently massive movers online.
Online from Costco.
Yeah. Along with things like housewares and, interestingly, tires.
Tires, huh? Makes sense, I guess. Avoids hauling them yourself. Okay, speaking of products, we can't skip the Kirkland signature stuff. That private label brand is such a powerful loyalty driver on its own. Any new KS items?
Oh, yeah. The product diversity under the KS brand just keeps growing. It's impressive. The new items they highlighted included, let's see, KS Organic Extra Firm Tofu,
Tofu, okay.
KS Grass-Fed Beef Sticks, a KS Combo Calzone,
Oh, wait, a combo calzone, Kirkland signature.
apparently also KS Chicken Jerky Treats for Dogs, and KS Whey Protein.
Okay, that KS combo calzone, I feel like that should come with a warning label or something.
Uh,
But the variety there, from, health and wellness stuff like tofu and whey protein to high-convenience items like that calzone, even pet treats, it really tells us they're actively trying to meet basically every need of that core executive member family.
Absolutely. It shows a real commitment to branching into specialty items, convenience items, things that drive loyalty beyond just buying paper towels in bulk.
Right, right. Okay, let's zoom out again to the overall financial health. Margins. That's always so critical for a bulk retailer like Costco, working on high volume and generally thin margins on the actual goods. How do they manage costs while driving all these sales?
Margins were extremely efficient, actually. The reported gross margin was 11.13%. Now, when you exclude the impact of volatile gas prices,
Right, got to strip that out.
the margin actually improved by 3 basis points compared to Q4 last year.
Okay, for those of us maybe not staring at spreadsheets all day, what does basis points mean again? And is 3 good?
Fair enough. Basis points are just tiny increments, 1/100th of 1%. So 3 basis points isn't a massive jump, but it's positive. It suggests they're getting slightly more profitable on every dollar of sales they make, even after accounting for costs.
Okay.
But what's really fascinating is when you look at what they call the core gross margin on core sales,
Core on core.
meaning the profit margin on all their regular merchandise, excluding gas, excluding other kind of fluctuating items, that core margin saw a favorable increase of 29 basis points.
29, okay. That sounds more significant.
It is. It means they're getting much better at managing the profitability of their core warehouse business.
So essentially, they're either negotiating much better deals with their suppliers, or they're getting dramatically more efficient at actually running the warehouses. Less overhead per dollar of sales.
It's likely a combination of both. Their operational engine is clearly getting leaner, more efficient. And you see that on the cost side, too. SG&A that's selling general and administrative expenses.
Right, overhead costs.
Exactly. That was also very efficient. It showed a favorable decrease of 9 basis points when you exclude the gas impact. Remember, a decrease there is good, means costs are lower relative to sales.
Got it. So their cost structure is actually shrinking relative to their sales growth. Impressive.
Very. They're managing costs tightly.
Okay, let's move to the bottom line then. Net income and earnings per share. The reported numbers looked good, but I think you mentioned earlier, if you just read the headlines, you might have missed the real growth story because of an adjustment.
Yeah, you're right to flag that. It's important. So they reported diluted EPS growth of 11.0% and net income growth of 10.9%.
Which are great numbers on their own.
Absolutely great numbers. But last year's Q4 results included a one-off non-recurring tax benefit. It was about $63 million or 0.14 cents per share.
Okay. So a little bit of a sugar high in last year's number that wasn't really related to core operations.
Exactly. So to get a true apples-to-apples comparison of how the underlying business performed year over year, you really have to subtract that one-time windfall from last year's result.
Makes sense. So what does the growth look like after you make that adjustment?
Precisely. When you exclude that prior year benefit, both net income and diluted EPS growth were actually significantly higher. Both clocked in at an impressive adjusted 14.0% growth.
14% adjusted growth on the bottom line.
14%, yeah. That's a substantial difference from the reported 11%, and it reflects really exceptionally strong fundamental performance in the business.
Okay, wow. So let's try to wrap this all up. We've looked at membership, sales, traffic, digital, margins, earnings. What does this all mean when you put it together?
Well, I mean, the picture is pretty clear, isn't it?
Seems like it. We're seeing adjusted double-digit growth in earnings, driven by that incredibly resilient membership base, 92% renewal in core markets, and really explosive growth in e-commerce, up over 16% for the year, plus strong international performance. It feels like a business model that's just operating flawlessly right now.
I think that's fair. And what's really fascinating to me is how they continue to manage that central strategic tension we talked about.
The physical versus digital.
Yeah. You see this really strong high traffic in the physical stores, this massive ongoing commitment to opening new locations.
Doubling down on concrete.
Right. And at the same time, this huge digital push is resulting in things like a 27% increase in e-commerce site traffic. These two worlds aren't competing, they're clearly feeding each other. It's creating this powerful, true omnichannel flywheel effect.
But doing both that simultaneous physical and digital expansion, that requires really heavy investment.
Oh, absolutely heavy. You saw it in their capital spending numbers. Additions to property and equipment, basically, investments in buildings and tech hit nearly $5.5 billion for the fiscal year.
$5.5 billion. And that was up significantly from the year before.
Yep, up from about $4.7 billion the prior year. That's billions and billions being poured back into building the future of the company.
A massive commitment, like you said, to growth on both fronts, digital and concrete.
Yep.
And, that leads us perfectly into our final thought for you, the listener, to maybe chew on. Given that really strong high-margin membership income growing at 14% adjusted, which is essentially pure profit funding the engine,
Right.
and also this huge increase in capital spending, pouring billions into both physical stores and digital tech, what is the ultimate long-term balance for Costco? Which path, building ever more physical stores around the globe, or continuously funding that rapidly growing sophisticated digital infrastructure, which one will ultimately secure the future for this bulk retail giant? Or is the answer simply both?
That's the multi-billion-dollar question, isn't it? Something to think about.
So definitely something to chew on until our next deep dive.